We're going right into it, buddy.
Oh,
Right into it, buddy.
how you doing? No intro this time. You caught me
No
off guard.
intro this time. I figured I'd mix it up a little bit in honor of episode 19.
There you go.
19 episodes.
Okay. All right.
All right. We've got I think we're about halfway through the year.
Yeah.
So what do we got? Like maybe like another 26, 22, 23 weeks left. I think we could double this up and maybe hit 40 before the end of the year. What do you think? I think there's enough time.
Definitely possible. I'm
I
down.
think it's a matter of you and I just making sure that we have our schedules in line.
Yes. Well, so far so good.
Yeah. You know, summertime, it's like those, summer hours.
Yeah.
We're not
I don't know
bankers.
what those are.
You're a banker. You don't really keep bankers' hours, though.
No. I don't know what that means.
So how you doing?
I'm doing well. Yeah, you're doing better than me though. We're gonna dig right into that.
Yeah. So for those of you who are watching this that do not follow me on social media, I got engaged to my longtime partner Jennifer on Monday night.
Congratulations, man! Congratulations. That was some presentation there. I was impressed. I was impressed.
Bro, after the amount of time that we've been together, I wanted to do something really special.
And you did that,
yeah. So I got I found this company that does like the whole setup, right? Like I surely didn't do that setup myself.
I was wondering. So you're a whole nother side of you.
Yeah, and then they had like the lights that say "Marry Me." They do the rose petals and the candles and the whole 9 yards. And then just for good measure, I threw in a violinist.
Wow! I tell you, you went extra. You are extra. And it was nice. It was really nice. It was a surprise though. It was cool seeing it on social.
Yeah, dude. Like she had no idea. Man,
that's great. That's the way you want it. Where was that? Was that at the old? Was that at Half Moon?
Yes.
Yeah, I thought I recognized that view. Yeah.
Now, Half Moon used to be something else, right? What was it before? I think Chart House, was it?
Yeah, it was a Chart House. Yeah.
Yeah, bro. Like it was a cool setup, man. Like we went for dinner, and then like it was a whole big thing, right? Like I was like, oh, we're gonna meet my mom for dinner. And then like halfway through, I was like, oh, my mom's not coming, because I didn't want anybody there for the actual proposal, I wanted to just keep it like me, her, and the kids.
Yeah, nice.
And it worked out well, man. Like I should get an Oscar for the acting job that I did pretending to be mad at my mother, God forgive me. God forgive me.
That was good. No, that was, it looked really special. You had a beautiful day for it. Sun was coming down. You couldn't have timed it better. Beautiful.
Yeah, man. Yeah. Congrats. Well, thank you very much. Appreciate that.
Absolutely. Well, that's why I threw out I think for the content for this episode, we'll talk about, and it is wedding season, so it's definitely a good time to be talking about married couples or newly married couples or couples planning to get married and buying their first home together. And
I'm with that. I'm with that for sure. Do you mind if we just hit some mortgage news prior to doing that?
Yeah, sure.
What's new?
I mean, nothing overly special this week. Mortgage rates are still kind of slowly trickling down, which is good. So I mean, they're not going up, and looks like within the next couple months, hopefully we'll get some more downward pressure on mortgage rates. And as soon as rates only go down 1/8 of a percent, it hits every major headline. So you start getting more activity. People saying, "Oh, I heard rates dropped," and it's like, drop in my world is 1/4%. I mean, that's a drop, but it's not, we're not talking 2s, 3s, 4s, or even 5s yet. We're still in the 6s on 30-year fixed rates, but it's better than 7s, but hell of a lot better than 8.
Sure.
So we're headed in the right direction. We're definitely headed in the right direction. So
I want to just check something here. Last week, what's today's date? Today is the 19th. So just compared to where we were 7 days ago. 7 days ago, we were, they're kind of just like, it's like a bumpy road, right? Like
And
you
that's the
see
way it's
little tiny
to be.
movements,
You're
little
gonna
tiny
get some.
movements. So
You'll get some news that cause it to go up a little bit one day, then you'll get more positive news that'll cause it to go down. But that's why we look at trends, and the trend right now is, it's heading down, which is nice.
good. Good. Well, that's great news for buyers and sellers alike. And home like commercial. We don't really talk too much about the commercial world, right? Like commercial lending, because most of our audience is primarily residential buyers and sellers. But there's a direct correlation between the rates, right? Like in commercial mortgages, they have to reset every 5 years.
Right.
So the pressure that these rates are causing on commercial owners is extremely stressful. So like these rates, obviously going down will obviously help those owners and the renters, right? Because like if the rates continuously go up and they got to raise the rents on the people who are renting, it's just everything is affected, and it's just so crazy how that works.
Right. No, everything is affected. I was just, talking to a buyer about, looking into buying a co-op that you're actually very intimately involved with. That's still losing money. I mean, these buildings are losing money, not because they're not well managed. It's because of just the pressure of inflation. So when you live in a co-op building, the only way, just like everything else, the way the business makes money is you got to raise prices. So all the other expenses in the building have gone up, and they set the maintenance for the prior year, it's going to lose money. So the way they correct that is by increasing maintenance fees on everybody in the building.
Yeah, or doing like those special assessments for like 12 months or something, try to catch up.
Special assessments, but also, but they have to be careful, because if they raise too much and people can't afford it, then they stop paying, which then causes a downward spiral, because now you have, all right, we increased maintenance to cure this problem, but we increased it too much. And now more people are not paying. So then what's the next move? You got to increase it even more for the people that are paying, so it can be dangerous, on co-ops and condos. Condos aren't excluded from that, with their HOA fees. They just, they cover less in the HOA fees than co-ops do.
And generally speaking, HOA fees are less expensive than maintenance because they're not including the taxes for the most part.
The taxes, and usually, just not an underlying mortgage that's being paid also as part of that. And depending on the way the condo is set up, maybe there might not be a superintendent salary or other kind of common salary, stuff like that. So yeah, they tend to be less expensive, but the condo itself is more expensive than buying a co-op. So.
What future reports do we have coming out that we can look forward to maybe try to drive some news or drive these rates in one direction or the other?
That's a good question. Let me see where we are today.
Today is the 19th.
Yeah. I mean, next week's a pretty slow week on the economic calendar. You got advanced GDP, which is coming out Thursday morning. Aside from that, I mean, there's existing and new home sale reports coming out, but those aren't usually big needle movers for rates one direction or the other. So should be a pretty slow next week, economically speaking. But we'll see. Anything can happen.
What is your take on election season and affecting rates? I know we've talked about it briefly, but how do you feel about that? Or what is your opinion on that? Do you think that like the elections drive rates one way or the other? I know they're not supposed to, because the Fed is a completely third party.
Yeah, I mean, when you're talking about monetary policy, it shouldn't have an impact. But who gets elected or which way the election is going will certainly impact how traders are reacting to who they might think is coming into office, or if the Republicans are taking over, or the Democrats are taking over. I mean, that always has impact on trading, which then will definitely impact mortgage rates. Mortgage rates are always very reactionary. It's hard to be proactive. We can be proactive by knowing what's coming up, but more times than none, the last 2 years, we always see what the forecast is for a certain report that comes out. It comes out the opposite way, and it throws rates completely backwards. So it's we always are kind of reacting to news as opposed to trying to get ahead of it. But we do our best with what we have.
Yeah, because you don't have that crystal ball that you so highly speak of.
Right. We have a crystal ball, but it's cloudy sometimes.
Yeah. All right, cool. So next week should be a relatively slow week. Rates should probably pretty much stay kind of like where they are.
Yeah, they might stay where they are. We might see a little, downside. They might continue, day after day if we see, better trading going in our direction, we might see a little decrease, but I wouldn't expect any major things happening in the next week.
All right, so let's talk wedding qualifying for a mortgage as a married couple. That was my tagline. Qualifying as a married couple for a mortgage.
Right, nice. So I mean, I get a lot of common questions for people that are just either getting engaged, planning on getting married, and I think the most common question that I get a lot of times, or comment I should say, is that I'll get a married couple that says, well, we want to buy something, but I want to put this purchase just in my name, and because I'm a first time home buyer, and then the next one I want to put in my spouse's name so they can use the first time home buyer stuff, and so you get people that are looking at the first time home buyer credits or grants or loans, and they don't want to use it up per se. But what the way the conversation always goes is what people don't realize, because they've never applied for a mortgage before, is if I drop off a borrower on the application, could knock down their qualification almost in half.
Yeah, because of the income.
Right. So if I have somebody that's not on the application, we can't recognize or use their income for the qualifying payment, which means, yeah, sure. If one person is making a lot more money than the other person, that could work out. And in some cases, if one person has lower credit than the others, and the person with the better credit has the higher income, I'll go with one person on the application. But just in general, what they would need to know is that if you drop someone off the application, their income drops off too. So it could, and if the income, let's say the incomes were just even, making the same amount, that means your qualification could be half as much.
50%. Yeah, of course.
So,
let's say the other partner had enough money to qualify. Like in a lot of situations you have, whether it's the man or the wife, one of them makes, significantly more money. If they could qualify, then in that case, the other person can technically hold off on putting their name on the mortgage, because they can use that FHA first time home buyer again.
Well, don't make that mistake either. FHA is not a first time home buyer loan. It's usually used by a lot of first time home buyers, but you don't have to be a first time home buyer to use FHA.
Yes. Okay.
FHA,
correct.
Time and time again, you just can't have two FHA loans at the same time. So if somebody buys a house with an FHA loan and then wants to buy another house, they either have to sell and close out that last FHA loan, or even refinance the old FHA loan into an investment property conventional loan and then buy the new one with FHA. So you can, there's things in there that you can do to utilize FHA more than once. The main first time home buyer loans are the ones that we've been talking about, the Sony May program, which is New York State. And some of the first time home buyer discounts just on conventional loans are for first time home buyers. Sony May, and this is where I get into that conversation. Sony May looks at total household income in order to qualify. So if I have one person that utilizes Sony May, okay, great. But then, if they buy that property and the spouse is now not on that loan, but on the deed, they still technically own the home. So they're no longer a first time home buyer.
Gotcha. And a lot of people don't know that either, right? Like that you could have your name on a mortgage and not on a deed, or vice versa.
Right. So, like I always tell, I'll tell people, because a lot of times people are thinking about buying an investment property in the future. And if you're buying an investment property in the future, you can't utilize a first time home buyer program because it's only for a primary residence.
Yeah.
So if that's the reason that, I want to leave my spouse off because we want to buy another property as an investment, well, that's not really going to work anyway. So it's, again, it's for people that are really just starting out, looking to plan and buy a place, whether it's a co-op, a condo, or a house. It's definitely advisable. And I tell people, let me look at the whole picture. Let me look at both your incomes, both your credit, both your expenses, and we'll see where that gets us. And then again, if I have to drop one person because maybe their credit is low and that's going to impact their rate. I just had this conversation with a new buyer where it was exactly that scenario. The spouse had a 20-point difference on their credit score. So dropping the spouse off, man, I can get them a better rate. And he was just able to qualify for the same house by himself, so in that situation, that's a reason why we would drop somebody off. But if I can still qualify you with the one income and get you the better interest rate, but in some cases, the person with the higher income if they have the lower credit score, then that's where you're using, so, and then but again, just in the last year, there's been a lot of, on the federal level with Fannie Mae and Freddie Mac, there's discounts for first-time home buyers if they're under certain income levels, which basically doesn't no longer factors in the credit score into the rate that they're getting if they qualify under certain incomes. The one that we've been talking about, where, you know, based on where people live now and that grant that we have associated, that also wipes out the adjustments for credit score. So first-time home buyers, even on regular conventional loans, if they qualify, are getting a better deal than they did just a year ago because of those waivers that are coming through. You know, so it's good. So that's, you know, again, that's a common question that I get a lot of time by new couples. The other, you know, has to do, you know, with, you know, wedding gifts, you know, and gifts just in general. And also down payment requirements. You know, we've talked about this on multiple episodes where, you know, I'll get a couple that's getting ready, you know, they're getting ready to get married, or they just married, and they think they need to save 20% to buy a home.
Yep.
You know?
Yep.
Still out there, you know, and that's just not the case. I mean, you can do 3%, 5%, 10% for a primary residence. You know, 20% or more is required for an investment property, but as a primary, you can do as little as 3%. In a VA loan, you can do, you know, no money down. You know, so.
And the VA loan, I know we've talked about this. I just want to reiterate, the VA loan, if you put down less than 20, you don't have to worry about the PMI.
Right.
Which is the property, what is it? Property mortgage insurance?
Private mortgage insurance.
Mortgage insurance. Yeah.
So, but,
so
we have all those options.
Let's talk wedding gifts, if you don't mind. I want to just, before we kind of steamroll through that, I want to just talk wedding gifts. So if you're getting, let's just say a lot of people, they have a big wedding, they get a lot of gifts. Are they allowed to use that money now? Is there anything that's stopping them from using that money as a down payment?
No, you know, so, you know, gifts are allowed, and now between FHA and conventional loans, both allow for the entire down payment and closing costs to be gifted. So it doesn't necessarily, so if somebody's getting a large wedding gift from their parents or something like that, if it happens while we're transacting, so if I'm doing the application in the next 30 to 60 days and we see those gift deposits going in, all we have to do is paper trail it back to the original source, you know, the donor of the gift. Do we have an affidavit that they fill out? How much was the gift? You know, all that stuff. And then it's perfectly allowable also. So, you know, which is always when I pre-approve somebody, you know, we're going over how much they have in the bank, how much they have in retirement accounts. But then I'll always ask the question, you know, are you getting a gift from family? And, you know, so that way I can talk them through what's going to be needed in the future to document that gift. Now, somebody's getting a gift now. So let's say somebody's getting married this month and they get all the wedding gifts, they put it in the bank. And then, you know, we're not transacting till September, October, November. When we do a mortgage application, the application requires that we have 2 months of bank statements in the file. So if they got married now, they're depositing all that money into the bank now. By the time September, November comes, it's
already sitting there.
Deposits, you know, so it's a little more streamlined than if we have to start sourcing multiple gift deposits.
Just to switch gears a little bit, one thing where my brain goes to is what about tax returns? Like, does it matter if you're filing together, joint, married? Like, does any of that stuff matter really?
Well, for almost all applications now, aside from maybe jumbo mortgages, we don't even have to look at the tax returns unless they're self-employed, obviously. But, you know, for W-2 employee borrowers, we're only looking at pay stubs in the W-2s.
Really?
If they own other property or they're self-employed, that's when we start looking at tax returns. But jumbo mortgages, you know, which in this area are loans that exceed, you know, 1.1 million, all those jumbo mortgages require 2 years of tax returns. So that's where we might start seeing, you know, things in there.
Gotcha. So self-employed, you have to look at tax documents. Besides that, you just need the W-2s.
W-2s, right? So, you know, filing joint, married, head of household, you know, that's all stuff to, you know, discuss with your accountant. But obviously, if you're married, if a tax return is needed and people are married, we should see a married tax return. But
whether it's married filing together or married filing separate.
Right. You know, so exactly. So, you know, and that's how people file their personal taxes. We'll just collect it and go off of there. But in most cases, we don't need the tax returns for conventional or FHA loans. So,
would somebody like me qualify for a first-time home first time for a first time home buyer thing, even though because I have other properties.
No.
No,
No, even if they're investment
even though they're
properties.
investment properties and there's just a percentage there, I wouldn't qualify.
No.
All right, so you gotta get Jen in there. Then we gotta get
the wheels turning already over there. Yeah. So,
I've already been thinking about this for like 3 years. You and I have had multiple conversations. Yeah.
I know.
Now it's starting to get like,
Yep, that's right.
Let me tell you something, man. If the rates weren't where they were right now, and I know we've had this conversation, we don't tell people that to buyers, but like for me, like I'm in the market and I see like, I just feel like for me personally, what I'm looking for, I need to just kind of sit back and wait and look for like that perfect property.
Right.
Because, and I tell her, like it's not necessarily the rates per se. I'm like, listen, if we can afford to buy a house now, then we'll be okay because the rates are, in my mind, I'm positive, I'm pretty confident that they're going to come down and we could just refinance it out.
Right. Yeah.
So if we can afford it now, it's not going to get much worse. Knock on wood, knock on wood. But
for new couples that are looking, that are getting married, they're planning families, they're planning, they're saving. I mean, the best person that they could speak with really is a financial advisor. I have financial advisors that we refer that are great for new couples. Some advisors really won't take on new clients unless you're moving money over and they're managing their money. But there's other advisors. There's a lot of other advisors though that like working with people that are just starting out. They'll put them on a budget. They'll put them on a plan. On okay, this is what your incomes are. This is what's going in. The common thing that I see a lot of times amongst even people that are, whether they're domestic partners or married couples, sometimes they still have their accounts completely separate from each other, and they have like, this is my money, this is their money, these are my bills, these are their bills, which again is fine. I won't make commentary on how people want to live their lives, but it's, if that's how you're managing it, then it's even more important to speak to an advisor who's going to be able to say, okay, this is what you're bringing in, they're bringing in. If you guys want to separate bills or whatever, sometimes it can make more sense to have one person managing the money and put everything into a joint account, and manage everything together, because then you'd be surprised how much more discretionary income there might be to start actually saving. But you should start looking into things like insurance or planning really for the future before you even have kids, and start looking at like, all right, well, if we have X amount coming in and this is what we're spending, you go over what your monthly budget is, then you know how much money you can save every month. As opposed to just kind of paying bills, and maybe you're accumulating some savings, but if you're really not managing it on a budget, it's going to be hard to save, for a down payment if that's what you're looking to do.
One of the things that I tell everybody is that you have to have a budget. Like if you don't know what your bills are and you kind of guesstimate like, oh yeah, I spend whatever, $3,000 a month on this and, and about 3,500. And then all of a sudden, you'd be surprised with those little tiny, like, what gets me all the time is like the subscriptions, the $9.99 here, $10.99. Oh my Lord. Apple ID, forget about it, man. I'm seeing like 7 different charges. I looked at my account last week. I see 7 different. I'm like, what am I subscribing to? 7 different charges of $9.99. Like, and I realized I had like a picture app. I had like Christian. I downloaded an app to help me measure the floors. I didn't have a measuring tape with me, and I forgot to take off the free trial. And for like 4 months, I just spent $40 on a digital tape measure.
I get you. That's how they get you. Any one of those things, it's like, all right, it starts out free, and then it starts automatically charging, and the only way to stop it is to get a call in to cancel. You get busy or forget about it. If it's only $10 a month, you're like, all right, it's not that pressure. But if you have 10 of those going on, that's $100 a month now. So it adds up. Planet Fitness is the best place. It's one of the best business models for a gym membership ever. $10 a month. Who's canceling that?
And it's very hard to cancel.
Well, you got to show. Yeah. Well, I don't know if they've changed it, but you have to go in person to.
You have to go, but Christian, you have to go to the gym that you signed up at.
Right. It's brilliant.
Like it's crazy. If you move out of state, if you move out of town, or you have to go to the gym you signed up at. So I had to I got into a huge fight with them. Like they ended up doing it for me, but like it's not like it was not easy at all.
Well, we'll leave Planet Fitness alone before we get sued. But it's a brilliant business model.
Yes, but budgeting is super important. I think that as a couple, like it's something that me and Jen have definitely talked about, and that now that we've taken this step, that I want to actually sit down and we have to figure out the whole joint account. But for people, you know, that's great advice. Like, just sit down with the financial advisor and figure out what the best way to do it is and to save. Because it might not, a lot of people think putting their money in a savings account is going to do it for you. But like, you could put money in a high yield savings if you're not going to buy a house for the next 8-9 months, whatever it may be, and get a better return than just putting it in the bank.
Right. You know, and then, you know, the big thing about getting married is it's obviously a huge commitment. So if you've already taken the step for that commitment, then the next financial move is to committing to kind of opening up the books. You know, like, what do you make? What do I make? Like, let's put it all together. Let's get a budget together. So, you know, if you're planning for the future, you're planning it now together. You know, you're a team. You know, so I you know, sometimes I do see people, and look, everybody's had past experiences in their life that, you know, they might be, you know, whatever, I'm not going there. You know what I mean? Yeah. Yeah, they're a little more hesitant, you know, but it's really, if you're planning financially for the future, it's really the best way to go, is to just, you know, get everything down. What are we spending? What can we knock off? You know, what can we do? And, you know, because like, you're putting more money into the pot, so there's more to go around. You know, so, and you're living together, you know, so you're sharing, you know, housing expense, all that stuff. It's, you know, but getting on the budget and knowing also, again, how much discretionary income you have. Like, all right, if we're saving X amount, like, the best thing to do, which I started very early on, was just having that money come out of your account automatically.
Yeah.
You know, and an advisor will set that kind of stuff up where it's like, you don't even see it. It'll come out of your account into another account every month, just like an expense. You know, so it's like a forced savings right there. You could turn it off anytime you want, but if once it starts going automatic, you know, then you know, like, you know, when I see how much I'm taking home, I know that that's coming out every month, you know, and don't think of it as a bill, because next thing you know, year, 2 years, 3 years, it's accumulating, it's building interest, you know, and that's really the way you want to do it.
You know what I found to be very valuable, and I don't know who else would find this to be valuable, but I set it up to be a completely different bank. Also, it wasn't just a different bank account, because the ease of just transferring stuff over when you're in a jam, like, I like to just not even look at it. And Jen has an account like that too, that she just doesn't even look at. She puts, you know, the real estate checks in there, and it just kind of sits there. And like, she has to legit, like, she doesn't even have the app on her phone. She has to go to the bank to do it. So it's just like those pressure points and those you know, the static there, the friction there, like, just allows more ability to save it and just not touch it.
Right. No, exactly. So, you know, but that's what we were talking about. And, you know, again, gifts are allowed. Other assets that people don't look at all the time. Sometimes people have an old 401k or an IRA from a previous employer that they can, you know, possibly, you know, either liquidate if it's an old one. If it's a current one, they can take a loan against it. You know, so there's other things you can look at. Like, I just had somebody that was in a bind yesterday. She was just short a few $1,000s, and she had a pre-approval from somewhere else. And I think I was the first person to ask her, like, do you have anything like that? And I mean, sure enough, she had an IRA that was, you know, just kind of sitting there that she can take. She didn't need a lot of it. She didn't need like, she didn't need like $2,000-$3,000. She was short, but didn't even know that that's something that she was able to use.
But it was her money that was there, instead of having to deal with all the gifting and asking people for it.
Right. Well, she didn't have the ability to get a gift, so that was really the only, you know, but she didn't even realize that, you know, or think about that is money that she could use to, you know, bridge that little gap of what she needed. So.
I think the most important thing when doing this is the two people make sure you're on the same page. Make sure that you kind of have a number in mind. Like, all right, look, we know that we can afford whatever, $2,500 a month, $3,000 a month, and then work backwards. Because
that's a good point, because I lead with that all the time. I say, you know, nobody has an answer. I would say, like, 1 out of 10 people I talk to, if I say, what do you think your monthly budget is for your housing expense? Have no idea. And then usually their answer is, well, that's what we want you to tell us. And I'm like, well, I can tell you what you can qualify for.
Yeah.
But I'm not going to, you know, but I can't tell you, you know, what you guys do. You might be going to dinner every weekend. I don't know what you're doing. You know, I mean, you might eat out every meal. You might be doing Grubhub for every other meal. I don't know, you know, what people's expenses are. So, you know, but again, I'll still start there, and then I'll go with, all right, well, this is based on what we look at, the maximum you can get. But now let's start talking about what that monthly number looks like. And they'll say, oh, wow, that sounds like a lot. Okay, well, now let's get it back down.
I don't like to look at that number. I like to look at the number like what we can afford on a monthly basis. And the math is it's not that crazy, right? Like, if you could afford $2,500 a month and you've got $100,000 down, all you got to do is just kind of work backwards, and you can figure out what type of a mortgage that's going to, like, what type of mortgage will be able to afford $2,500 a month, and then add that to $100,000, and then that's your budget.
Exactly right. That's exactly right.
Obviously you got to play into the taxes have to play a part in it too, but that's
all that
pretty much,
stuff together.
yeah, it's pretty much the gist of it. And start small, right? Like when you're first getting married and you're first starting a family and you're doing these things, start with the small. You don't need to go this big lavish sort of situation. Start with something you can afford. That way you're making strong financial decisions right out of the gate.
The stepping stone property, yes. And condos, co-ops are great for stuff like that. You're paying a mortgage every month. Your value is going up, your mortgage is going down, you're building equity, which becomes savings, on top of what you might also be saving. So, exactly right.
That's a really good point. I tell people that all the time, that when you're buying a house and you're paying that monthly number, for the first year or two, yeah, a lot of it goes towards interest, but it's like a savings account. You're just paying it, you're putting it in there. And then when you go to sell, you're going to recoup it all and probably then some, because the property's 99% of the time, we're talking about this historically, 5%, 3 to 5% increase in property values.
Right. But even if the value stayed exactly the same, you're still getting that, principal money that you paid down on it back, to your point, so as opposed to renting every month where you're getting nothing back.
That's the biggest key, man. That's the biggest key. That is the biggest key. All right. This was super helpful. I'm going to make sure Jen watches this episode if she's not watching right now.
All right. Congratulations again to both of you.
Thank you very much, man. I'll see you next week.
All right, Steve. Thanks, man.
All right.